Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Tonight, consumer prices jumped 6.8%. That is the highest jump since 1982. The S&P 500 hits an all-time high. And the Congressional Budget Office stated today that Biden's Build Back Better plan will add $3 trillion to the deficit. That and more tonight on Wall Street Wrap-Up. Hi, welcome to Wall Street Wrap-Up. Hope your week went well. I'm Andre Laborde. Our goal is bringing Wall Street to your street for today, for Friday, December the 10th, 2021, and to get you ready for the week ahead. Well, November's CPI report, which reports what consumers pay for goods and services, was released today, and it found inflation is more widespread than originally thought. It moved up 0.8 of a point for November. Now, inflation, it was reported today, hit a 39-year high, not seen since 1982. Now, to put that in perspective, the hit song in 1982 was Olivia Newton-John's Let's Get Physical, and the Jay Giles Band was singing My Angel is a Centerfold. Does that give you some idea of just how long ago we haven't seen this kind of inflation? With over a year in lockdowns and preferences do change. Okay, you may have known that. Well, many of you may not have stayed at home and your businesses stayed open, but many did stay at home and only recently returned to work. Bank of America had a survey this month and found 88% of you prefer working now at home. And 70% now that you're at home are planning a home improvement project. Bank of America also found that 30% still want to move to a less densely populated market. And 54% of you of home projects were adversely impacted by supply and or labor shortages. And Christmas is just around the corner, actually in just a couple of weeks, 2 weeks. If you're like a lot of people, there's still a lot of shopping to do. But unlike most years, the supply disruptions, inflation, and some empty shelves, we may not always get what we want. Coming up will be my guest this evening, Steve Sadoff. Steve is the former CEO and chairman of Saks Fifth Avenue and chairman of the board of the National Federation of Retailers. And Steve is also senior advisor from MasterCard. Steve will be telling us if you don't have what you want yet, will you be able to get what you need? And Steve will be here in just a minute. But first, how did the markets do this week? Well, all the major indexes were up for the week. In fact, the S&P 500 had a record close. The Dow Jones Industrial Average ended up 217 points for the day, up 4% for the week. And the S&P 500, well, they were up 3.8% for the week. And finally, the NASDAQ. They finished up a little over 3.5% for the week. It was the stock market's best week since February. And mentioned a record close for the S&P 500. It was. And by the way, John Murphy, an analyst at Bank of America, is bullish on Rivian. Rivian is an EV electric vehicle truck company with a price target now at $170 a share. And speaking of Rivian, Adam Jonas, auto analyst at Morgan Stanley, has put the company as a buy with a price target at $147 a share for Rivian. And Morgan Stanley has also raised their price target on Apple to a $200 a share price. And even though we're in the middle of December, J.P. Morgan has named the number one pick for 2022 next year. It's Walt Disney, with a new price target for Disney at $220 a share. Well, let's get to our guest this evening. He was the former CEO and chairman of Saks Fifth Avenue. He was also chairman of the board of the National Retail Federation, and he's also senior advisor to MasterCard. Steve Sadoff is his name, and he's here with us tonight. Hi, Steve. Welcome to Wall Street Wrap-Up.
Happy to be here.
You know, I'm thinking Thanksgiving is over, Black Friday is, and Cyber Monday is in our rearview mirrors. Are retailers optimistic that this Christmas season and the fourth quarter is going to be a good one?
Oh, I think this is going to be a very good holiday season for retailers. You've seen a strong consumer for the last number of months, and it stayed through the holiday, through the Thanksgiving week. It continued to be strong. It's less promotional than it's been in the past. I'm guessing, I don't know the exact numbers, but probably 5 to 10 percentage points less promotional than you've seen. So that means that the retailers' gross margins are going to be healthy, and I would expect to see it continuing through the end of the year. Right now, it's going to be an issue of, do you have any of the product that you want available? Because the consumer was out there early grabbing it because of some of the supply chain issues. So I would expect in the last couple of weeks, you're probably going to see a lot of gift card sales.
I think I was watching Doug McMillon, who is the CEO of Walmart, and he was saying, and I think the CEO of Target was talking about it also, is that they were saying they had extra inventory to be ready, where you've got some retailers that are hoping to have enough inventory. Is it because you're looking at such large box chains as a Walmart or a Target has the extra space to have it, or did they just plan ahead? Why do some retailers have more inventory, according to what they're saying, and others are not?
Well, I think there's plenty of inventory. I think it's going to be a question of whether it's the right inventory and whether they have some of the hot items or not. I think the Targets and the Walmarts had a lot more power in terms of ability to get some of the shipping. They planned well in advance. They're better planners. They have a little bit more leverage in getting some of the container ships in. And I think they did a really good job of getting the product. Some of the smaller retailers had a harder time. And they also had to deal with a lot higher costs in getting the product. So some of it, they might have to airship things in as opposed to shipping them. So I would expect that you're going to see a situation where it's not about, is there any product on the shelves? I've been out in the stores. There's plenty of product. It's finding that item that you really want to have in the style and the size that you want.
True. I'm hearing statements like, if you see something, don't wait till later, get it now. So I guess that's exactly what you're talking about. It may not be the actual brand name you're looking for, but it may be the product you're looking for, but not the type brand. But if you see it, buy it. Don't think it's going to be there on the shelf 2 weeks from now.
Even getting to the point where we're already past it. I think that a lot of the really hot stuff's already largely probably being sold out in terms of hot toys or the hot electronics items or that it dress that you want to have. So it's going to be, there is a scarcity of those key items that's out there right now.
Normally, with Black Friday, and then normally right after Christmas, there's the discounting. Okay, will there be as much discounting or any discounting as they had in past years?
Nowhere near as much. There's discounting. That's part of the game. When products are priced at full price, they're assuming that there's going to be some form of discounting. Let's say in apparel might be 20, 30%, but you're not going to be seeing those 50, 60% off items that are hot items. There might be a little bit of clearance at the end of the season with those kinds of discounts, but you're not going to broadly see it. There just isn't the product availability this year. And remember, product was ordered 6 months ago by a lot of the retailers, and we were in the midst of the pandemic, so they didn't buy as much product. So they were being very cautious. So there just isn't as much to discount of the product. It's going to be really interesting as we go into next year because they're now ordering for next fall and next summer. And they're probably saying, boy, the demand is a lot better than we thought. And you're going to see, assuming that the supply chain starts to ease up as we go into the second quarter of next year, you're going to see more inventory coming in. And if retailers do what they always usually do, is they're going to order more than they need. And a year from now, we're going to be back to a more normal situation where you see deeper discounting. Look at the third quarter margins. They're terrific because they're discounting less and they're getting the pricing.
You're talking about the inventory. Well, I'm thinking also about, let's say, inflation. Now, if a buyer is buying a product, let's say 6 months in advance, well, let's just take a shirt, okay? That shirt that's being sold today was actually made 6 months ago, maybe 7 months ago, or give or take. Well, was there the inflation at the time? I'm thinking the cost to make that shirt to what they're selling it now is that I would assume their margins are much greater, so they'll be making more money. But I'm curious for, like what you just said, if you're ordering something today in December that will be on the shelf in 6 months from now, that inflation will have to be cost factored in. Am I
No question. Oh no, you're right. I think you're in the midst of seeing some of the price increases going on. The products that are coming in now are starting to be much more expensive, not just from the containers and the shipping costs, but the price of cotton and other raw materials. So you're seeing much more full price selling. And this is across all categories. You're not seeing discounting going on in cars. You're seeing some price increases across a lot of categories. We saw an inflation rate in the 6% range last month. So that's going to be, we're in for a period of time. And it's not just the raw materials, it's labor. It's all of these pieces are contributing to cost increases, some of which you've already seen, but you're going to continue to see as we go into next year.
About 2 to 3 weeks ago, I was watching the CEO of Hanesbrand, and Hanesbrand said that the cost of cotton is at a 10-year high right now. So it just goes back to what you're saying, is that this is going to be, normally when I talk to CEOs, I'll ask, and I've always found many economists when I'll ask, is this inflation temporary or is it long lasting? And I found a lot of the economists are going, it's temporary. But the CEOs, the ones that are in the C-suites that have to buy and purchase that product, they're normally telling me, for the most part, that it's going to be here for much longer. Do you fit in that category? I mean, you're CEO.
Yeah, and look, I think you've seen the government now stopping using the word transitory.
Exactly. It's now been banned by Jay Powell.
I've never seen wages go up and then come down. I've seen raw materials go back up and down. So you've got pieces of the inflation that are clearly long-term, the wage increases, and with the low unemployment rate and the number of just go anywhere and you see the job openings and you see people who are moving jobs, moving around jobs. So I think that the labor component is clearly going to continue. And some of the raw material shipping may come down, but they're going a little bit, but they're still going to be much higher than they were in the past. And that's got to be factored into the pricing of the products.
Yeah.
I think who wins, the companies that win are the brands that have pricing power. If you're in a commodity market where you don't have pricing leverage with your brand, you're in a much tougher position than if you're able to pass the pricing on because you have a strong brand. And you've seen many of these companies price more than their cost increases so that they're able to maintain margins. And that's where you've seen some of these really good results out of in the last quarter.
Would this mean, Steve, that you're looking at maybe large box stores being able to absorb a lot of these costs much better than small mom and pop stores that are selling maybe the same kind of apparel?
Not necessarily. I think I'm not so much thinking about the retailers as I'm thinking about brands themselves.
Okay.
So if I'm a brand that's a hot brand, I don't know, let's take the handbags and you look at Coach and Michael Kors or brands like that, you're seeing that they've been able to take their cost increases, but they've been actually able to sell their products at higher prices and get better price realization. So their AUR is up. And that to me is what a strong brand does.
People's tastes change here and there, and it's really a tough one, I'm assuming, on retailers to know, like what you were saying, what the taste will be 6 months from now or 8 months from now when you're placing your order at this moment. So, and I usually use the example, like, when I buy men's suits, okay, today with more people staying at home, it's tough on maybe clothing stores that sell men's apparel of suits because there's not as many people yet going back in the office, but maybe at a later date. Is that tougher for buyers to being able to figure what will be in 6 months?
Fashion, that's the nature of fashion apparel. They have to make bets relative to what's the fashion trend going to be. Right now, apparel is performing exceptionally well. It was tough in the pandemic when everyone was at home wearing sweatpants. Now, as we're in the reopening phase, everybody wants to get out. But they want newness, and they want fashion, and they want sexier, and so it's a different environment. And so you're in a new fashion cycle. but picking the right fashion is, that's why you have winners and losers in the apparel world all the time.
Yeah. Another good reason I think about this pandemic, though, the glass is half full, is that because so many people were at home and they didn't go work out or anything, they're going to need new clothing, because I think they've found that their clothing has shrunk a little bit from when they do finally have to go back into work. And
You're absolutely right. And that's why I think one of the big trends is fashion, but comfort. So it's not just the sweatpant, but it's having a little bit of fashion, but bringing some comfort to it for exactly the reason you're saying.
I would imagine the largest manufacturers are either, like, say, in China or in Vietnam. Will retailers now think twice about maybe having a manufacturing company so far away? Will they try to maybe make it closer to home?
It's an important question, and every company's wrestling with it right now. You talk about near sourcing and bringing back domestic sourcing for a lot of the businesses. Some of it can't be done overnight. It takes a long time to be able to change the supply chain and the manufacturing capabilities. The issue that you've got to deal with also is cost, and the consumer clearly wants it to be made local, but they also want to pay a certain price, and their market's only going to bear a certain price on products. So every manufacturer's figuring out what's the right supply chain for them, and how do you protect availability. And when you've had Vietnam, use your example of Vietnam, and the factories are all shut down because of COVID, and you can't get product, you say, boy, I'd much rather have some availability in the U.S. So you're seeing a lot of production trying to be coming back to the U.S., or a mix of the U.S. and overseas. And I think that you're going to see that over the next several years. And the question is, how do you do it affordably in terms of bringing the right cost so the consumer isn't going to have to pay that much more for a product?
Because it's, as you were mentioning before, the labor cost will kill you trying to keep.
The labor costs are going to be can be a lot higher depending upon how much the labor is in the manufacturing. The labor cost is quite a bit higher in the U.S. than it is in some of these countries.
Is it cheaper? Is it cheaper with container cost to shipping it back in? With that, you're saving on that cost, but you're paying it on labor here. It's more expensive with U.S. labor than it would be having it in China or Vietnam and paying for the shipping cost, right?
Well, I think that's what every company is going to have to evaluate. Until now, it's been much cheaper to produce it overseas. That may or may not. If you bring some manufacturing efficiencies into the U.S., you have the higher shipping costs. You may say from a quality and availability of product, you may rather have it in the U.S., and that's the decision companies are going to have to make.
I found in the last week or two that more employers are at least telling me that, and I'm seeing that that bottleneck of wanting labor so bad is now easing up a little bit. Do you think that the labor shortage is now easing up as we get closer into the Christmas season and then the early 2022?
I don't think it's eased up yet. I think we have a ways to go. Clearly, once the wages go up, they don't come down. But I think we still have a disconnect between the available jobs and people who want to fill them. You walk down, and I think a lot of it's in the service sector, restaurants, retail. There are certainly many, many more jobs available. Some of them have gone out of the workforce. Some of them have moved over and worked in, let's say, an Amazon warehouse. And so you've got to, still have shortages of jobs like truckers. We have, I think, 80-some thousand truck driving jobs that are open. So there's still a lot of excess jobs that we have to start working through. It's not going to solve itself by Christmas. I'm hoping as we go into next year, it'll start to ease.
If you're just joining us, we're talking with Steve Sadoff, former chairman and CEO of Saks Fifth Avenue. Got a lot more to discuss in just a moment. We're glad to have you back. We're talking with Steve Sadoff. Steve is the former CEO of Saks Fifth Avenue. He is also a former president of the National Federation of Retailers and also senior advisor at MasterCard. I reported last week that one of the analysts, I think it was at Morgan Stanley, raised the price of the REIT at Simon Properties from malls to $180 a share. Well, I bring that up because now people are getting out of the house and going back to brick and mortar, or going, it seems, I guess, to the malls. So do you see around the United States that more brick and mortar malls or stores are going to be having more foot traffic and people just want to get out?
About it.
Yeah.
No question about it. I mean, during the pandemic, we went from pre-pandemic about 82% of commerce was done in a brick and mortar store, and let's call it 88%, I guess, and 12% in a online. And during the pandemic, we had about a 50% increase of online shopping to about 18%. Still says 82% of people are shopping in a store. And as we're in recovery from the pandemic, people want to get out and they want to go in stores and malls. And you're seeing a resurgence in the malls. You're seeing a resurgence of department stores. People want to get out and experience. Restaurants are doing really well. So you're in a moment where there's an opportunity for all of these types of stores to excel. And the real issue is going to be, what's the experience that the consumer has when they go into the mall, when they go into the department store? Is there enough labor there to serve them the way they want to be served? Are they going to have availability of product? And time, right now we're in that sort of World Series. This is the moment that you're able to reintroduce people because they haven't been in these stores for a year and a half. So I think it's a really interesting moment because the Simon Malls, you're using that as an example, or the Macy's. This is their time to be able to show, hey, they can really deliver that experience that is differentiated from just the online. The consumer they have perfect information, and if they don't have the experience that they want, that they really appreciate in the store, they'll just shop online.
This week, I think it's Engine Capital, which I'd never heard of Engine Capital before. It's a hedge fund. They took, I think, about a 1% stake in Kohl's department store, because what they're pushing them to do is to separate their e-commerce business from their regular brick and mortar. And I know at Saks, I think Saks had already done that. And if I'm not mistaken, I think Macy's hired advisors, Alex Partners, to review it, to research it. Why do companies want to possibly break up their e-commerce, especially with as you just mentioned, e-commerce rose 50% from the pandemic. So you're looking at that sector, the e-commerce rising with the brick and mortar. Is there a reason for that?
Well, the reason would be to be able to capture the difference in the valuations of .com companies versus brick and mortar companies. You've got some of the .com companies selling at 3 and 4 times revenues versus a much smaller valuation for brick and mortar companies. And some of these companies that you just mentioned are being valued as brick and mortar companies. The question is whether or not you can provide a seamless experience to the consumer, because you got to always start with the consumer. And if the consumer can have a seamless experience and you can get the valuations, and there's a reason for why you're doing the split. So at Saks, for example, which they've done it, and I think they're doing it quite successfully, they took $500 million of cash on a $2 billion valuation, and they were able to dramatically increase their investment in their .com business. It was underinvested. They didn't have enough inventory. They were able to improve the technology, and that then became a reason to be able to accelerate the growth of the .com business. And there's a reason for a luxury marketplace that Saks has a great name to be able to be a leader in providing. The question that you have to answer for a Macy's or a Kohl's or for others, and by the way, the shipping costs for a Saks are a relatively small piece of the total, what I call average order value of a .com purchase, and you may or may not have to pay a sales commission rate. Those are different scenarios than you have at a Kohl's, where the shipping cost is a much higher percentage.
I'm just curious of whether or not, if just again, as you were saying, it looks like the e-commerce portion is rising 50% in the last 12 months or so, there will be a point, I'm assuming, and please correct me if I'm wrong, but there'll be a point where the brick and mortar will plateau out. You know, the e-commerce is rising and brick and mortar is decreasing. But they will be, and if they worked in tandem, that's one thing.
Regardless of who does it, it has to work in tandem because the consumer wants a seamless experience. You know, they already are. If you're in Macy's, you're already one of the top 10 e-commerce companies in retail. So they're already working in tandem today. The question is there some way that you can unlock value by doing a separation? And that, again, the jury's out in terms of whether that makes sense.
What about Amazon? When Amazon purchased, and I'll say Amazon, it was just, I think officially it was Jeff Bezos bought Whole Foods. But when they bought Whole Foods, I'm assuming the thought process was behind, they had the e-commerce of Amazon, and they wanted to work, as we were just talking about, in tandem with, with a brick and mortar. So they decided on picking Whole Foods. Do you think that was a good decision?
Oh, I don't know whether, Amazon's a remarkable company and having remarkable growth. Whole Foods is a great retail shopping experience. How they're using it, how they're using the data, how it plays financially for them, I wouldn't have any comment on. I happen to admire both Whole Foods and Amazon.
Steve, it's been such a pleasure. I mean, 20 minutes just flies by. I hope you come back. It's been a delight.
Happy to.
Thanks, Steve. Steve Sadoff. Well, if you've got a question about finance or a comment about the show, we'd love to hear from you. Make it pithy or concise and write us now at Andre at wallstreetwrapup.info. And now for a look ahead for what's in store for next week. But first, what consumer electronics company was originally named Sound of Music but changed its name in 1983? We'll have that answer in just a minute. Well, what consumer electronics company was originally named Sound of Music but changed its name in 1983? Best Buy. Well, we've got some great guests coming up in the weeks ahead. Now, coming up in a couple of weeks, we're going to be talking with Mario Gabelli. Now, Mario is the founder, the chairman, and the CEO of Gabelli Asset Management and also Gameco that has mutual funds. It's got over $40 billion of assets under management. 2021 is now coming to an end, and how does he see 2022 shaping up? And where is he putting his money to invest so we'll know where to put our money? Next week, and that's Mario Gabelli. Now, next week, we're going to be talking with former Federal Reserve President and from the Bank of Kansas, Thomas Honig. Tom, in addition to being the former Fed Reserve President, was also the former Vice Chair of the FDIC, the Federal Deposit Insurance Corp. Inflation is hitting a 29-year high today, and the economy, what's it looking like for 2022? Well, we'll find out. We'll talk about that, plus a lot more, with Tom Honig. And as a reminder, we repeat the show on Sunday mornings, but always the best way is to set your DVR so you'll never miss an episode. And that's our show for Friday, December the 10th, 2021. Hope you've enjoyed it. My thanks again to Steve Sadoff for joining us this evening. But as always, we appreciate you for allowing us into your homes tonight. And remember, you can always follow us on social media, Facebook, YouTube, Twitter, and WYES.org. So have a fun weekend and a productive week ahead. I'll see you next week for Wall Street Wrap Up. I'm Andre Laborde. And remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.